2009 federal budget in review. Last night, as we're all well aware, the federal budget came out. Now, this is what we call the Clayton's Tough budget. It had more holes in it than a sinking ship. A lot of information was leaked about this budget way in advance before it coming out. Now, it wasn't as tough as the government sort of pointed out it was going to be, but there certainly is a lot of devil in the detail, and there's certainly some things that you need to be aware of. Now, obviously, it'll take us a couple of weeks to digest the full extent of the budget and come out with new strategies for our superannuation clients and obviously all of our investment clients. But right now, we just want to touch on a few of the points which come of particular interest. Now, I'm not going to go through details about where the spending is going to go or the infrastructure work they're going to be doing, but I'm just going to touch on the issues that are relevant to financial planning. The infrastructure spending is a good overall thing for the marketplace, as it will create jobs and obviously it will create stimulus and it will get ongoing income and benefits for businesses in the longer term. So that's a given. But what we want to look at today is just exactly what the federal budget means to the investor and what happens or changes in their account today. Now, if you're a superannuation client, obviously the big issue here is they've cut your concessional contribution limits by 50%. This means if you're under 50, you can only put $25,000 into super a year. If you're over 50, you can only put $50,000 a year into super. Now, this will reduce the amount of money you can get into super. Now, they haven't touched the super regulations. It's still tax-free after age 60. It's still a good environment to have your money in. They've just made it tougher to get it in there. And what this has also done, again, the devil's in the detail, it also means that those who heavily salary sacrifice to reduce tax and make contributions to their super will no longer be able to do this. On average, it'll mean around about $8,000 extra tax dollars you'll be paying this year for those who are salary sacrificing heavily into super if you're over the age of 50. So just be aware of that. There are some traps and tricks in this sort of budget, and it certainly has cut back the superannuation salary sacrifice strategy. Now, we've also seen the co-contribution payments reduced from $1,500 to $1,000. So that was if you put $1,000 into your super fund and you were under certain thresholds, the government would equal that and put in $1,500. Well, they've cut that back to $1,000, so now it's 1 for 1. Overall, not too bad. It's still a benefit for your super itself. Pension drawdown relief has been extended through to 2009-2010, which means that previously you had to pay, say, 4 or 5% of your super as a minimum payment each year. Now that's been reduced by 50%, so you have to pay for half of that. That's to take into account the drop in your super balance with the markets pulling back. So again, that's probably a positive sign, and obviously the industry welcomes that. Personal income tax has been left the same. It's been left as the Howard government has had recommended and promised. So that's a positive for the marketplace and certainly a positive for those paying personal income tax. But wait, there's more. You certainly will have to pay more tax because there is a few little tricks and traps which will come up in a few minutes. Now, Centrelink itself, they have increased the pensioners' weekly pension to by $32.49. So that's a positive for the pensioners. Certainly, it's a welcome. For couples, it's been increased by $10.14 a week. Again, a positive for pensioners, and it's a very welcome thing. However, in doing that, they have pushed the pension age out to 67 by 2023. So those who are looking to retire at 65 on the age pension, check your birth date. You may have to wait for a couple more years. But that's all right. We all love our jobs. Now, small business tax break has been increased from 30% to 50% for small businesses less than $2 million turnover. Again, another positive and should be stimulating the economy as small businesses may look now to go out and buy some capital equipment, get that deduction, get that rebate in quickly, and obviously move their business forward. It will encourage some spending. Now, for families, there's a few tricks and traps here, and you need to be aware of this. Private health insurance rebate has been progressively reduced to nil depending on your income levels. So those of us who have private health insurance and claim back the rebate of 30% in our tax every year, now we have to be a little bit more careful because it certainly has changed. It is a sliding scales. For singles who make less than $90,000, your rebate will cut from 30% to 20%. If you make between $90,000 and $120,000, your rebate will be cut to 10%, and if you earn over $120,000, you'll get no rebate on private health insurance. Obviously taking away the incentive to have private health insurance because it will cost you substantially more. However, don't worry, they've upped the Medicare levy to make sure you stay in it. Now, if you're a couple, it's a little bit different. If your household income is above $240,000 per annum, you will also get no rebate for your private health insurance. That is a sliding scale, so between $150 and $180, you'll get a 20% rebate as opposed to a 30% rebate you get now, and between $180 and $240, it'll be a 10% rebate. So the private health insurance is going to be a little bit stressed to that industry, as people probably will decide to pull out of that private health insurance, putting more pressure back on the public hospital. However, the government has put an incentive for people to make sure they do keep their private health insurance, and that is they've increased the Medicare levy surcharge. So if you fall within the surcharge thresholds, the surcharge was 1%, that's been pushed up to 1.25%, as a minimum, and what we're seeing is a maximum of 1.5%. So this will incur some additional dollars. But wait, there is more. There's also a bit of a trap in there regarding fringe benefits payments. Your taxable income will now be you now have what they call an adjustable or adjusted taxable income. Now what this means is the government will adjust what your taxable income is when they assess your Medicare levy surcharge, and when they assess your Medicare levy, and when they assess your family tax benefits A and B, as well as things like pensioners cards and the gold card and healthcare cards, that type of issue. What they're going to do is push up that. So basically what we're saying is your taxable income is your net income after expenses. They're going to add back to that any losses from rental properties and any salary sacrifices into super. Now this will bump your adjusted taxable income back up, meaning you may miss out on some of the rebates. For a lot of families, it probably does mean you will miss out on the family tax benefits Part A and Part B, obviously costing you a little bit more. And obviously for some people who have private health insurance, adding back those rebates may push it up a little bit. Now, probably the biggest negative here, the hardest thing to adjust for this one, will be those of you who own investment properties. Superannuation salary sacrifice you can unwind pretty quickly, but investment property you can't, especially not in this property market. So you have to have sit down and have some thought about what you're going to do regarding your future and how you're going to invest your money going forward, because the government is cracking down these things, and it certainly won't be as tax effective as it was previously. Now, other issues regarding family is the 18 weeks maternity leave available for eligible working mothers coming in 2011. Now, that's a positive, obviously. The catch with the government is funding that. The only real catch is that that payment will be taxable, and I don't think that's too outrageous at all, quite frankly. There'll be a boost to the first homeowners grant. The boost of $7,000 will be extended for 6 months, maintaining the current level for the next 3 months before starting to scale back and drop off. But that's just the boost. That's the extra $7,000. After the 6 months is up, you'll still be entitled to the first homeowners grant. For new constructed property, it'll be $14,000. For existing properties, it'll be $10,500. So there's still, that grant is still there and still available to you, although a little bit less than what it was previously. Now, they're probably the key factors that are going to affect investment clients. Obviously, there's a lot more to the budget than that, but we're just focusing right now on investment super clients and obviously tax issues around the budget. What is really interesting here is transition retirements are still in place, pensions are still in place, but if you've got one, you're certainly going to need to go back to the drawing board and reassess how much is salary sacrifice into super. You can still make undeducted contributions into super of up to $150,000 a year. Now, they have changed the way they've calculated that contribution, but at this point in time, you can still make those contributions, so you can still get money into super, albeit not through a tax-effective way. So the general thrust of the budget for investment side of things has been to give more back to the pensioners, to the lower income people, and tax the higher income through alternative means, I guess is how they say it, as opposed to just directly increasing your tax rates. So you just need to be careful for that, and it certainly would pay for everyone just to sit down, take a look at what they're doing, take a look at how that may affect their family tax payments Part A, Part B, their Medicare levy surcharge, their private health insurance, and just see if you're getting the best value for your money. It certainly is a time to revisit these issues and take a good look at them before 1st July, when the new tax season kicks off. We've got a couple months to do that. Now, for more information, go to our website at growyourwealth.com.au. We will post some more details about the budget in our newsletter this week, coming out next Tuesday. And if you have any questions or queries, feel free to give us an email or give us a call on 4771 4577. Thank you.